Good Thursday morning, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer? It's up there for us all to view.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to help answer questions, provide you with guidance, give you advice. So there's the disclaimer. And with that, let me get started. Today's session, if you guys have questions, please put those questions on a live chat. Will's watching them. He'll read it back to me. If you want to come on the show and ask your question live, we also provide a link to Zoom. Click on that link, takes you over to Zoom. Once you get to Zoom, click on raise your hand. There's a button there, raise your hand. Once you click on that, it'll prompt you to turn on your camera. You don't have to turn on your camera. Once we let you in, everybody will be able to hear you. You could ask your question directly. It could be Market Chameleon tools, data analytics, strategies, maybe something you've seen unusual or have a question about. You're welcome to come on the show and share that, because that is what this is about. The first half hour is really to take questions and try to help the community navigating Market Chameleon or the different analytics and the tools that are available. While we're waiting for questions to come in, what I'll do is take a look at the pre-market report as usual, see what's trading at pre-market hours, and I'll default to some questions we have coming over from the emails. Usually I get those questions coming in from the emails. A lot of people don't have time to be on the show at these hours, so they'll email me questions, watch it later, or they just feel more comfortable asking questions that way. So I'll start out. I know Laurent sent an email. He mentioned yesterday regarding the naked put spread screener. So I'll try to get to that. There are a couple other things that I'm noticing right now coming in that have some common elements to it, and I'm going to try to talk about that. And it's really due to the volatile markets, and as volatility is increasing and things are whipsawing around, some people are getting hurt, and I wanted to kind of bring up the questions that they're asking me, and we'll talk about that. It has to do with really respecting risk and analyzing risk prior to entering the trade. You should, and these are things that I see. I wanted to mention what's going on, because some people, are coming in telling me, this month's been terrible. They've been doing well for 2 years, and all of a sudden what they've been doing is not working. So we'll discuss that. Of course, if questions come in, let me know. We'll take those questions as well. Okay. So pre-market, yep. These are stocks trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. We got 48 stocks on our percentage gainers list, 155 stocks on our percentage decliner, on our biggest percentage decliners list. From this perspective, we're looking like a more bearish bias at the open. Of course, yesterday Fed came out, raised interest rates. Now we're close to that, between 3 3/4, 4% on the Fed funds rate. And, they indicated that we still have more to go. Perhaps now we might go as high as 5% into March, by March of next year. They didn't issue the plot. For some reason, I thought that they were doing the plot table, but they didn't do that. And that basically indicates what they're forecasting going forward. They so this announcement, they didn't do that, but they did give us some indication how they're thinking, that they still see inflation elevated. They're still looking at raising interest rates, and they don't know how high they're going to have to go, but they think that they might have to go higher than they've previously estimated. And another indication, they said that the next rate hikes may not be, as big as they have been in the last couple. Not 3/4, maybe they'll go down to a half and then quarters.
I mean, it's amazing how off that plot has been.
It shows you how hard it is to forecast things.
I mean, imagine how it must have looked 2.5 years ago, 3 years ago, right?
Oh yeah, they thought that inflation would be low forever, and it does give you an idea. Think of it this way: what the Fed is doing. Obviously they have a very tough, difficult job because they're looking at lots of data throughout the economy, trying to set monetary policy appropriately and to hold down or keep inflation in check while having full employment. And they got it wrong. And when we're sitting here trying to, just as hard to try to estimate a company's earnings, and the Fed has access to, PhDs, lots of data, lots of tools, lots of analytics. They're looking at this every day. They're talking to businesses. They're talking to banks. They're talking to some of the brightest minds out there, internally and externally. And still, you could see how much you could error by. Which will get me to what I wanted to talk about was risk. But let's finish up looking at the pre-market report. And then I wanted to talk about risk because some emails are, telling me, people have lost a tremendous amount of their capital in the last month. And we've been, like 75%, 80%. They're emailing me, not a lot of people, but some. Some people are emailing me the opposite. So I'm going to tell you, I'm getting two different types of emails. I got emails where people are having some of the best years in their life. People have been trading 20 years, and then some people are telling me that they've lost everything they made in the last 2 years. But the ones that I think have gotten hurt do have something in common, and that's what we'll talk about. Let's filter out this report to S&P 500 companies. Right now we're looking at a report. It includes small cap stocks, ETFs, leveraged products, closed-end funds, preferreds. We'll remove that, look at only S&P 500 companies to get a sense of what's going on there. To do that, I'm going to use this filter here in ETF. When you click on it, you get a list of ETFs. If you select one of these ETFs, let's do SPY. That's the S&P 500 ETF. And the list below will get filtered by stocks that are holdings in the SPY ETF. And here you could see, which are the S&P 500 constituents. Here we could see 4 stocks made our percentage gainers list, 32 in the percentage decliners. From this perspective, we are looking like we're setting up for more bearish buys at the open. And a lot of these big tech companies are now starting to really, I think, reality's catching up, and they are starting to go down. Let me see which ones are hitting 52-week lows. So over here, new 52-week lows. These are the biggest percentage losers, but the list of 52-week lows is high. And you could see here, Meta, Qualcomm, Google. These are big tech companies. And I think what Meta, Google, were the FANG stocks, right? Those were the stocks that were doing, they were driving the market higher. Those were the favorites to be in. And you could see that things are really catching up to the reality that things are slowing down. They're not immune from a recession. If there are no questions, Will, let me jump to, before I get to Lauren's question, I did want to mention this, and we're getting, a couple people have sent that this volatility, they got whipsawed. And part of it is they probably, and I don't get big insights into it, but, some of it is that the things that they've been doing in the last 2 years is no longer working. And the markets shifted. The markets are different. There's more volatility, the higher interest rates. And when that happens, you're going to have to adapt to it. That's part of trading. Part of trading is to adapt. You're going to have to change your tactics. You're going to have to change your strategy. You're going to have to accept that there's a new reality, and that as interest rate, cost of capital goes up, volatility goes up. It's harder to price assets. It's harder to forecast earnings. It's harder for companies to navigate. Volatility in general will go up, and there's more uncertainty, there's more risk as cost of capital goes up, and you will have to change your tactics. You can't use the same tactics. And if you're saying to me, I've lost 75% of my capital in a month, or 95% of my capital in a month, then you're doing something wrong. That shouldn't happen. You shouldn't be in that situation from the start. And we talk, when I show you guys yesterday, we're showing these plots, in SPY. Why do we do, instead of just selling a put, if you're looking at an outlook that the stock, that this put, you want to sell a put, you think the stock's going to go up, why do we do put spreads? Why do we sell this, right? We sell a put. Why do we look at put spreads? Why are we looking at this chart? Like, why would I show you this chart? If it didn't mean something. And the point of it is, we're looking at what is the risk before we even enter into trade. You have to accept the risk you're taking prior to entering the trade. You got to respect that risk. You can't sell a put and then say, if it goes against me, then I'm going to manage my risk. Because that's what the question is, well, what if it goes against me? How do I manage my risk? It's too late. It's like saying, well, if I don't want to buy it, if I'm going to buy a house, I don't want to buy fire insurance or flood insurance. I don't want to do that because it costs me money. It's going to eat into my profits. But if there's a fire, how do I manage? How do I undo that? How do I trade out of it? It's too late. It already hit, right? If you put on an unacceptable risk from the start, and then you get hurt, it's too late. You can't manage the risk after the fact, after the house burned down. That's it. You can't buy insurance afterwards and get the money back. It's over. And it's important to know your risk before you enter into trade, and know what your max risk is, and that it's acceptable. It is unacceptable and almost impossible, okay, to be successful in trading if you have a position on that could lose you 75%, 95% of your capital that quickly. That in a few trades you've done that, then there's probably no way in the long term, that you could be successful at it, because eventually it's going to hit. So you have to know your risk your max risk, and it has to be acceptable to you that you can't blow out, you can't lose 75% of your portfolio on, especially, that the market is already volatile. You probably should be reducing, your risk per trade, or diversifying more, or waiting for the markets to make bigger moves before you enter into a trade. But this is why we're looking at, showing you these graphs, so you could take a look at it and say, okay, I stand to make $179. If I'm right, if I'm wrong, I'm down here to 421. Is this acceptable? Can I handle that? Can I keep trading, or am I out of business? And if you're trading that you're out of business in a month, you're never doing anything, in my opinion, that you could have succeeded in the long term. I put this up. Somebody asked me, to draw, use the notepad, and we discussed this. These are the minimum things you need for a successful trading operation. Education, it's important. You need to learn what are the markets, what are stocks, what's the difference between some people don't know the difference between a common stock and a preferred stock, and you're jumping in there, throwing all this money at it. So there's poor education from the start. Nobody gets, I don't know, Will, did they educate you about risk in stock market from, in school? I don't think I had that I don't think they mentioned it, maybe the stock market, but really we didn't get a good education on risk. And
no, so not on risk, no, but invest in a couple of my econ classes, business classes, I did have it in college, but real life is the education, right? And
right.
doing your research,
Right.
doing your education over time, and what we do every day, right?
Right. And educate, it's key. And it's ongoing. Education's not reading the book and then I'm done. It's ongoing. You're always learning. Things are changing in the financial world is complex. People think it's not, but it is complex. There's lots of things going on there. Research.
Well, I mean, you think about the last 10 years. I mean, I was speaking to my brother yesterday, who some people may remember, but he's really big into NFTs and these historical NFTs. And it made me think about the first time he told me about a Bitcoin. It was $32 a Bitcoin.
Yeah.
And, that was the start of the financial education on cryptocurrency, which is,
right.
It's something that's, it's ongoing, right? I laugh at it. And, all my commentary was super negative. Like, this is, the governments would never allow it, will destroy trade, taking the other side of it. And, it was debated all the way up to, 90,000. I still haven't bought a Bitcoin.
Right.
But I've been educated on it. Lots of discussions, lots of
reading. Right. And that goes into research. When and what I mean by research is that sometimes I will spend 6 months on trying to build a model before I ever do a trade. And I might have to scrap it. It might not even work out, and this, and you have to read, you have to be knowledgeable of what's going on in the marketplace, what's coming up, how things could get influenced. It's not your research cannot be limited to looking at a chart. Okay, that's not going to, if that's where your research is limited to turning on your execute and looking at a chart, the odds are not, go read about how your odds are. Don't take it from me, just, read the probabilities of it. Risk management. This is important because you're in a business of trading risk. That's what it is. You're not in a business of buying and selling, apples, or buying and selling, sneakers, or buying and, selling, some kind of service or technology. You're in a business of carrying risk. That's what it is. So if you don't have a good risk management tool in there, then, then you're missing a really big part. Execution, yes, this is important, and this is where here's where people focus 90%. When I see people having trouble, they're focused here, like, I don't know, probably 95% of their time they're doing this execution. You open up your brokerage, account. You need, of course, you need a broker. You need some way to enter your trade in and get executed and get fills and so forth. So it's important. But if this is what you're doing, and I'm including, like, obviously people are, putting up a chart, and what does a chart do? A chart is, you're gambling at this point, okay? And in my opinion, the way people use charts is it just basically triggers your emotion to do a trade. That's what it's doing. And 95% of your time is spent on there. It's wrong. I'll tell you how much of my time do you think I spent on execution? Like,
Less than
relative
1%, I would guess.
Yeah, exactly. This amount. That's the execution is the very last thing. That's when people ask me, well, can watch you trade? Well, what are you talking to? Do you want to watch me, sit there and read books and educate myself? Do you want to watch me, for hours thinking about how to move data in Excel and research it and figure things out? You want to watch, 99% of what I do is just sitting there thinking and moving things and learning. And that's a big, and if you're just, of course, this is the easiest part, right? Execution is the easiest part, because anybody, right, who is 18, whatever, has enough money, can get approved for a brokerage account, put some money in there and start buying and selling, right? That's the easy part right there. So if you're doing this like 95% of the time, and it's your money, look, that you can do, at that point, in my opinion, you're just gambling anyway. Like, I can't help you. There's no thing, I can't tell you, go execute things faster or better. It's nothing can help you. It's just, you have an urge to gamble, and if there's a bull market, maybe you'll do well for a while. But this is important here. Research, education, you need these, right? You need to be willing to devote a lot of time to that. And a lot of you do. Like, I gotta tell, a lot of you send me really good articles, and give insights that I don't find, and I learn a lot even from the community. So I don't want to say nobody does. Like, a lot of you do this, okay? But just wanted to bring that up, that this here is where you should be concentrating. This here, that should be just 1% of what you're doing.
Indeed, Rob did have a question, and quite a few chameleons said it was a great one. He's asking, I think where is it? Will, do you and Dimitri have a % of capital that you use for trading and another for investment and another for cash? I guess he's asking how much. I mean, Rob, are you asking how much do we put at risk per trade? I mean, we've talked about it a bit before, like, 1 to 2% of your capital should never be used to put in on more than one trade, wouldn't you say, D?
Yeah, and it's probably it's way less for me, and a lot of what we've been doing is that our Market Chameleon we built from our trading capital. So all our lives, that's what Will and I did, that we traded. We were traders, we're market makers. We didn't come from a marketing background. We didn't come from like a different technology background. All we did was trade. We used that capital to build Market Chameleon. And Market Chameleon, at this point, you might like the story, Will, but at this point, Market Chameleon is our business, and we use that capital to invest in it. Okay, so we don't have the time or the capital to sit there and just trade like we did intently, because we do use that capital for MarketChameleon. We try to look for investments to grow this. And but here's interesting. I might not be able to get to Lauren. I can't get to your question, but I promise I will tomorrow. I think Lauren had a great question, and it was like a lead into this, because Lauren's question did have to I think he had a really good question regarding implied volatility and looking back 4 years and saying, well, 4 years is not as relevant as this last 1 year, because now we're in a different volatility period. And he's correct. And I'm glad that he asked that, because that's good thinking. Well, I need to look at more relevant data to make better decisions. And I'm going to get to that tomorrow. Okay. This one longer than I thought. But here's an interesting story. Well, my daughter, she's 16 years old, and she's coming home. She's like, Dad, like a lot of my friends are getting into the stock market, and they're coming up, and all of a sudden they started coming up to her and they said, hey, Isabel, does your dad own MarketChameleon? And she's like, yeah. She's like, oh, I just signed up to his website. I was using that. I didn't realize it was him until I got like emails and started watching his shows. But I guess I'm bringing that up. Well, it felt good that she said that, but at the same time, we were thinking like, who can our audience be? When we're analyzing, like, where are they? How old are they? And well, now we have a group of people trying to learn that are 16 years old.
Yeah, that's amazing. I thought everyone was my age and older.
Yeah. And she said, yeah, they're like big fans. They watch our show. I thought you would enjoy that.
That is cool.
And,
I thought your cousin Andy was our youngest fan.
Yeah, well, no, now there are younger ones. Now we got younger fans, 16 years old. They're watching and trying to learn and saying that they're learning a lot.
That's awesome.
I'm going to show you. Yeah. Somebody asked for a visual. Lauren, sorry I didn't get to it today, but I will, because I think it was a good question, and we'll do it tomorrow. But here I'll show you. Somebody asked to show visuals, and here's a house, and a lot of people invest in real estate, right? So I drew like, this is my real estate, this house. And what you don't realize is that you're already doing a lot of hedges the industry has created for you prior for you to take in a risk. All right. What are you doing before you buy this house? Right. You got an appraiser, you got that you're hiring to make sure that this house is reasonably priced. You're locking in a mortgage 30 years. This is hedging you in case interest rates spike, you're locked in. You're buying insurance in case of a flood, in case of a fire, and all this stuff. You're going out and getting an inspector. You're paying the inspector in case that the roof collapses, if maybe there's electrical problems, all this stuff. You're probably renting it out for 12 months. This way you're locking in your rent, so it's not fluctuating from day to day or month to month or week to week. You're doing all those hedges, right? And you probably don't even realize. And a lot of people are not doing that when they're trading their account. They're not doing it with and options, I think, offer a great way to build wealth, because if used correctly, they give you an opportunity to use leverage. Just like when you're buying a piece of real estate, right? You're using leverage. You're putting 20% down, you're borrowing 80%. So if you buy a house for $100,000 home, you put down 20 grand. If that house appreciates by 20,000, right? Goes from 100 to 120. Well, you just made 100% return. right? Because you only put down 20%. So you made 100% return on your invested capital. Options allow you to tap into that leverage, but you have to use them correctly, because those tools not used correctly can really, hurt you. And hedging is important. I'm just showing you, even in the real estate market, you're doing lots of hedges, because you could imagine if you said, I don't want to pay an inspector, that's going to eat into my profits. I don't want to buy insurance, that's just going to eat into my profits. I don't want to lock in a fixed rate. I'll get a variable rate, so it doesn't eat into my profits. I don't want to do all these things that you're doing to hedge yourself. If you take all those hedges away, then all of a sudden you're exposed to a lot more risk, right? And eventually that risk could bite you and really take you down. All right, guys, I'm gonna let you go.
Well, you were just mentioned as an invest encyclopedia.
I was mentioned in investment encyclopedia.
Well, Alex said you're like a financial encyclopedia. More like a professor of MarketChameleon. Awesome job, buddy. Thank you.
All right, guys, stay safe out there. Have a great trading day. I hope to see you guys tomorrow.
And we're going to take Lauren's question tomorrow, right?
Yeah, we'll take Lauren's question tomorrow. It's a good question. Then I could focus on that.
Perfect. And Lauren, if you want to come over in the morning and discuss it too, feel free. We'd love to hear that. All right, cool, D. See you tomorrow.
All right.